Righty-tighty. So, yeah, we started off with macrometrics. So I wanted to start from, big picture first, sorry. And which is macrometrics, because the property and stock market is not an indicator of economic health. So really, we have to look at the things that control stuff or the world finances. So we have the central bank levers, which basically they can do two things really. So they can print currency and open liquidity lines. They're pretty much the same thing, and they can drop/increase rates, as in interest rates. They're the only two things you can do, and as we've seen, from the subprime mortgage collapse in 2008, they basically firewalled every single one. They dropped rates as low as they could go. They couldn't do anything else. Then they started printing like no tomorrow, and moving forward to where we are now, they're pretty much they can't do much other than drop rates even further into negative rates, which is where we're going to go. And then we're going to keep on printing, which we'll see in a bit. So here are the health indicators. Internet instability issues. 1 second, let's double check I have both internets connected. Yeah, I do. Interesting. So these are the health indicators. So we have currency velocity, sovereign corporate and private debt, GDP and SME growth, PMI, Purchasing Managers Index, unemployment, and so they're really the health indicators, and delinquencies, bankruptcies, and bailouts are, I guess, the repercussions. Yeah, they're the repercussions of what happens. So this is the most important chart that there is on the planet when it comes to world economics. It is the most important chart, and it's the chart that no one talks about. And I don't know why. This should be the first thing that everyone, that financial sites talk about on TV and stuff like that. But no one is. And you can see that from 2000, or really from 1998, currency velocity just fell off a cliff. Then we had the tech bubble pop. That didn't help. We tried printing back then. It actually worked. So the stimulus we did in 2002 did work to a degree, but then it was just game over from 2006-07 onwards. And the amount MV has just been dropping, and so they've been printing currency at this rate to try and spark MV. So you have to understand that this is done on a quarterly basis. So this shows us that for every dollar that enters the US economy, how many times it's transacted in a 3-month period. Now, one down here, this right bottom axis down here, or not axis, this level. This means that if MV gets to 1, it means $1 doesn't move in a 3-month period. It moves once. Another way to look at this is that for every dollar of stimulus, or every dollar added into the US economy, it creates $1 of economic growth, let's say. So when you get to just below 1.0, let's say it gets to 0.99, it's game over. It's literally like jumping off a cliff, and you can't do anything to stop it. Because what this means is that the more money they print, the worse the situation gets. For every dollar that enters the economy, it sucks out $0.99. So that's not good, and they're doing everything they can to try and stave that off. Now, if you look at the currency printer, this is M2. You see this little uptick here so basically the COVID bailouts and all that sort of stuff. The US currency supply jumped from about 16 trillion to 20 trillion odd. I mean, there's like just over 4 trillion printed in a year. Absolutely insane. Well, that massive injection of cash only sparked this little uptick in velocity. It's a joke. It is an absolute joke. And now things are dropping down like really badly. This is why Biden is trying to get in a $6 trillion stim pack, because they need to try and push this back up and artificially force this back up. So when you compare both of them, you can see that this is only going to go up and MV is only going to go down unless they bypass the banks. You have to understand that the way what happens. Let's actually, I may be doing a bunch of doodles, so let's actually open this. you have to understand that it's like a three-way fight. It's not us versus the banks. It's like a little fight between central banks, commercial banks, and the public. So what happens is you have the central banks over here wanting to obviously get MV to go up, and the way they do that is they are trying to get liquidity into the markets, but they have no mechanism to do that. Well, they do, but they don't use it. So what they're trying to do is a bit of a cat and mouse game here. They have the commercial banks, so JP Morgan, Goldman Sachs, etc. They basically open up shitloads of liquidity lines and basically unlimited free money, pretty much, and they try and flood them with like a fire hydrant type amount of bandwidth of capital, and in the hope that they lend to the public. But the banks obviously don't trust it, or we are seen as high risk. So this never happens. And what happens is that the commercial banks just gobble it all up, they absorb it, and it just gets transferred really and absorbed by the stock market and property market, i.e. corporate buybacks. So what happens is the public, they won't lend to the public because we're high risk. But if IBM or a big company like Walmart says, hey, do you fancy lending us $20 million? We'll pay you, I don't know, 0.25% or 1%. They're like, yeah, sure. And so IBM then goes out and buys their own stocks, and that's what pushes up the stock market. So the central banks are trying to get liquidity into the public, but the commercial banks are just hoovering it all up, which is why MV isn't picking up. That's why MV is doing nothing. The only way MV comes up is when they do helicopter money, and helicopter money is when you have direct money from the central bank directly to the public. Now, with the current infrastructure and the financial system, you cannot do that with fiat money as we know it. So this is why they will be rolling out CBDCs, central bank digital currencies. That is the only way they can do it properly. As I said, that if they're clever, they're going to make it time stamped, so you have to use the money within, say, a month. That way people can't hoard it. So this is why CBDCs are coming. They are, and they're going to eventually place euro, the dollar, the pound, etc. From a trading perspective, so if I was just to log on here to this account, so when we're looking at the currency charts, when we look at a chart, say euro dollar, we're currently trading, fiat euro, fiat dollar, etc. Well, eventually, let's say 5-10 years later, we'll still be currency trading, but it will be crypto euro versus crypto dollar. Nothing will change for us. Nothing. So, oh wow, look at that on euro dollar. Sorry, a bit of a tangent there. Pop quiz, what pattern is this?
Double top.
What'd you say, Chris?
Double top.
Double top. I can neither confirm nor deny. Because this is a regulated asset. Oh, actually, I can. I'm not saying buy it or sell it. So, yeah, this is a double top pattern. So, anyway, let's move on. So, that's that. Then we have to look at sovereign corporate private debt. So, again, this is total public debt as a percentage of GDP, well above 100. So, yeah, it's just nuts. And this is a picture I took of the US debt clock on the 10th of June 2020, so just over a year ago, and we had 25 trillion, almost 26 trillion in national debt. And then I took a picture just before the weekend, and that's what it was. So it went up 3 trillion roughly. And then all of the numbers are just insane. But it's hard. You need to actually look at the real debt clock as it's moving to really understand the shit show that the world is in. I know we're focusing on the US, but it's the same in every country. Look how fast the national debt is here on the top left. It's going nuts. Now, you're also looking at this and going, GDP is going up. you have to take this with a big pinch of salt, because the US is the only country in the world where they include their military spending as part of GDP. So all of their military research, R&D, etc., goes into GDP, which literally has no gross domestic product or uplift. It's just, it's a sham. It's a bit like their unemployment figures. So, where's unemployment? Oh, it's here somewhere. Come on. Payroll, no. Where is unemployment? Debt, money creation, trade, US population. Can't see it. Okay, it's probably on something else. So the other thing with unemployment figures, you can't really listen to them anymore. They've massively obfuscated them, because if you are unemployed for a certain period of time and you're still unemployed, I forgot what the time frame was. I think it was like if you've been unemployed for over a year, or is it 15 months or something like that, the US stops counting you as someone that's unemployed. They then term you as terminally unemployed, and they take you off the figure. So all the unemployment figures they're looking at, like, over the last 6 months or 12 months, etc. It's not the real figure. Jerome Powell, the Fed chair, actually admitted that the other day. He said the unemployment figures are a lot higher than this. So yeah, it's crazy town. Then again, look at non-financial corporate debt. So this is non-financial, means any corporate which is not a bank or a financial institution. So just general companies that are non-financial. Their corporate debt is just growing and growing and growing. And so yeah, we really are getting into the everything crash, and it could be anything that sparks it. I mean, there's a auto loan bubble, there's a student debt bubble, there's a pension bubble, there's a currency bubble, there's a bond bubble, and a stock market bubble. Just look at the Nasdaq. The Nasdaq is the biggest joke I've ever seen in my life. The Nas, here we go. Because guess who's doing the most corporate buybacks? Oh yeah, tech companies. It is just, that's the March dip, and this is where we are right now, and we're having a bit of a sell-off as we speak. Right now, I wouldn't say sell off. It's sorry. Interesting. Yeah, it's not a sell off. It's just a little pullback. I mean, if anything, looks like a bit of a low test on the daily chart. But so where's it? Sorry, too many screens, too many tabs. Trying to find my PowerPoint. There we go. Purchasing Managers Index. So this is the official definition of purchasers, the PMI. I prefer my one. It's easier to understand. Are big companies that build stuff and make stuff actually buying stuff to grow for growth/manufacture? So if I'm a big company that builds steel rods for stuff, and I'm the purchasing manager for this big steel rod factory, I have to go out and find freaking steel. And so this is what PMI is, and so it's a good indicator of is the world actually doing stuff. So here's the Chinese PMI. It fell off a cliff during 2020. Everything paused, but we've had a big spark up. Like a V bounce of some sort, and we're actually higher than where we started in March 2020, which is interesting. So not all of these charts are doom and gloom, by the way. Again, we don't know if there's any fudging going on with the numbers like they do with GDP and unemployment, but just face value, look at the charts. The whole world seems to be, in terms of production and manufacturing, pre-COVID. In fact, slightly higher than pre-COVID. So US is gone pretty high. Euro, way higher. Japanese, higher. Chinese retail sales, standard. So, Chinese public, obviously pause, craziness. China stopped, lockdowns and masks and stuff like that. I mean, you should have seen the Wuhan New Year's Eve party. There were like 1 million people all partying with no masks, nothing. It's ridiculous. And so, yeah, and then everyone's really happy, starts spending. So it's as before. US retail sales, again, the US public. It's been a bit of a yo-yo, but it's as normal, really. Euro, same shizzle. And then, yeah, So I was looking at US industrial production, and I thought, Jesus Christ, it's gone high. And I thought, did Elon do that? Because he's been selling lots of cars. SpaceX has been doing all sorts of fabulous things. But then I looked at domestic auto production, and it's like a terminal death. This is going down. And once level 5 autonomy is out and allowed on the roads, the car industry will change forever. It is literally the big short. Like, once level 5 is out, you could easily take on some 5-10 year shorts, as in a short, and just leave it forever, because the car industry will die, as we know it. It'll go away from selling cars to miles driven via hell riding, hell riding as a service of some sort. So the result of all of this seems pretty train wrecky, and I think it is. Well, the reason being is that they're just trying to print their way through it. And this is a great picture. Look, it's got square wheels because the whole infrastructure is defunct. And they're trying to, jump this sucker. And this is real footage from inside the Federal Reserve. Yeah, so they're just going to print. So this is where crypto comes in, and to a degree, this is a very tenuous link. I had a look at USM2 on TradingView. I was trying to find a candlestick chart, and I found it. It looks awesome. I mean, isn't that the most bullish chart you've ever seen in your life? Not a single red bar in sight. Now, why is there not a single red bar in sight? Because the US Fed never stops printing. They're perma printers. And so I then converted this chart into an area chart and made it red. Actually, let's see if I can do it this way. We don't need to. Yeah. So what's happened here is I've chopped up. So the M2, so the US money supply is just the M2, not the whole money supply, but M2 supply is just over 20 trillion. So I chopped it up into 5-year chunks. So it took 224 years to get the first $5 trillion in existence. Then it took 11 years to get the next $5 trillion. Then it took 8 years to get the next $5 trillion. Then it took 2 years to get to the next $5 trillion. How long do you think it'll take to get to the next $5 trillion? Well, I can already draw this in. It's going to be 1 year, because it's coming next year. Biden's stim pack. It's going to be, I think, something like a $6 trillion stimulus package. So after 2022, how long is it going to take for the next $5 trillion? Probably a year every year at this rate. Some people may think, it's obscene, Simon. They're not going to print $5 trillion a year. Well, just look at Lebanon, Argentina, Venezuela, any country that's ever experienced the beginnings of big inflation, as in monetary inflation, not price inflation. Mind you, they go hand in hand. So I then did something else. I thought, okay, what's the CAGR? What is the compound annual growth rate? Well, and I chopped it up into 20-year chunks. So from 1960 to 1980, they grew the money supply by 19.15%. 1980 to 2000, 11.05%. And 2000 to 2020, 14.15%. So, and this is just going to continue to increase. So let's just assume a conservative 15% CAGR for the next 20 years. That puts M2 at $60 trillion by 2040. That's insane. $60 trillion. I then took my little geekiness one step further, and I thought, I wonder what the crypto market cap is as a percentage of M2. So if we look over here, back in why is this not? Let's exit this. I want to show the whole thing. No. Display settings. No, you can't see the bottom. Balls. I'll do it here. You can see it better clear here. So in 2014, the Bitcoin market was 0.08% of USM2. Then if we fast forward to, we then had the 2018 top, but Bitcoin hit 1.878% of the USM2. Dipped a bit, obviously, then came up. And so as of January this year, Bitcoin alone is 2.73%. of US M2. So my next question is, how long will it take until Bitcoin's market cap is 100% of US M2? Now I don't know. I could give some back of the fag calculations, but it's going to be a lot sooner than you think. So we know that M2 will exponentially rise. This will continue to make people poorer, roughly 15% a year. So you have to sort of give this a 15. You have to imagine that the global currency supplies, no matter what country, they're all expanding their own supply roughly 15% per year, if you took a big average. So that is your hurdle. That is your investing hurdle. Imagine being an alien visiting Earth, looking at all of this completely objectively, and seeing everything I'm just showing you. The natural conclusion they'll say is, okay, well, if you want to get wealthy, you need to make at least, well, just to break even, you need to make 15% ROI per year with all of your investments, as in your total net ROI for all of your investments. I mean, it's all very well and good seeing people on Twitter and YouTube go, "Hey, I made 10,000% of this random shitcoin." Well, you didn't rate. That wasn't your whole account. You probably put $100 into shitcoin. Went to, take me with Kishu. I put something like $374 into Kishu, and it turned to like $10,000. But it's that ROI I got wasn't of my whole account. So your whole life ROI every year needs to be 15% a year just to break even. That is why I don't get out of bed for anything less than 25%. And really, I'm looking for 50% a year, at least. Rising M2 will only continue to inflate Bitcoin. So the more the central banks push the currencies, guess what? It's just going to give Bitcoin a higher high. Bitcoin is simply a massive bouncy castle. But it will expand. And so the big blower that inflates Bitcoin are the central banks. And Bitcoin is therefore a wise move to insulate from insidious wealth erosion and make a large net wealth growth per year. I mean, Bitcoin's average 200% CAGR each year. Will it decrease? Yeah. But let's say over the next 10 years, whatever, it decreases to 100% CAGR or 50% CAGR. It's still freaking better than stocks, property. So then this then leads us into on-chain analysis. So what is the exact probability of Bitcoin bouncing up from now? So, but instead of like plucking a random figure in the air, with on-chain analysis, you can actually find an exact percentage probability, and it's basically you can look at the whole of Bitcoin's price history, see where it is now, and go, right, statistically there is a X% chance that it'll go down or go up, and you'll see. Now, again, here is my warning caveat. I'm going to literally bombard you with a bunch of slides now. Don't worry if you can't remember all of them. I'm going to have to